The bank crisis fear still hanging around like a bad house guest. A new Bank of America fund manager survey is hitting the most bearish levels of the year. Managers positioning for, I don't know, I guess you could call it the financial apocalypse by keeping their cash levels elevated and the highest bond allocation since March of 2009. And I know most of you remember that was the market bottom during the financial crisis. Should you follow the position for the apocalypse or a bull market? Let's get right to the floor show. Joining me now in studio, Equity Armor Investment CEO Luke Rabari and Great Hill Capital Chairman Tom Hayes. Tom, sometimes extreme bearishness signals that the turnaround's already begun and maybe some of these fund managers are late. But the X factor is the vapor trail that this bank crisis has left behind. I'm talking the most recent one in March. Where are you compared to the fund managers in your bullish-bearish scenario?
Well, Liz, the secret to happiness is low expectations, and that's exactly what we had coming into the earnings season. Earnings were expected to drop 6.3%, and what we've seen already from 16% of the S&P reporting is that 78% beat, and they're beating on average by 5%, despite some of the earnings that you saw from Tesla, et cetera, some of the one-offs. So we remain constructive here. Not only are managers the most overweight bonds relative to stocks since 2009, they have the lowest growth expectations, they're the most pessimistic, and the most pessimistic towards real estate.
And you're saying that's a contrarian indicator right now.
Absolutely. You know, markets don't bottom when everyone's overweight cash and bonds. They don't top. They top when everyone is overweight equities, and they're overweight equities with leverage, and there are no marginal buyers. So when everyone's in cash, the pain trade is higher, and that's why we're climbing this wall of worry.
I don't know. Luke has a look on his face like, Tom, let me get in here. I'm sensing a little bit more bearishness, or at least concern.
Yeah, I've got a lot of concern about a lot of stuff. But to what Tom says, we are staying invested. But as volatility gets lower to these levels, we put more volatility on. And as stocks are going higher, we're lowering our stock exposure. We're selling some calls against our positions. We think the good times have kind of been over. And there's a couple of worrying things. Number one, the S&P and the NASDAQ. The NASDAQ is up 20% for the year. The S&P is up 7 or 8. The S&P is made up 50% NASDAQ stocks. So over 50% of the S&P is NASDAQ stocks.
And haven't the leadership names been kind of the same? Microsoft, Apple, who else?
All the same. And the interesting thing about them is that the ones that have the biggest balance sheets, the strongest balance sheets, are the ones that have done well. Even in the energy sector, look at Exxon compared to some of the other companies. Microsoft, Google, Apple, although Meta was really beaten up, they have a big balance sheet. So we think people are kind of, and they're laying off people. They're not laying off people because they're expecting a lot of business. So even if the market doesn't crash, then they have to ramp up. There's going to take some time for that. And by the way, 2% inflation, I mean, when that happens, I'll be under 200 pounds again. That is not happening. My personal inflation rate is easily over 10%. This 5% stuff is, I wish it was 5% for me, but it is not.
Tom, I think Luke's right. You got to know what you're investing in. Yeah. I'm in the S&P 500. It's very diverse. It is, yeah. But there is a heavy weight to tech. Yeah. When you look at the Russell 2000, for everybody out there who says, oh my God, I absolutely love the small and mid caps, 16% of the Russell 2000 is made up of banks. Yeah. And not gigantic ones. And if you look at what the Russell has done, since, I don't know, the recent high, which may have been around February, we're looking at a one-week chart now, but you can see the big drop-off, and that was before the financial crisis, the mini crisis or the mini panic crisis that they're talking about. I don't know, can we put up since February? So there it is. You can see where we were. That was a two-handle. 2007 was where the Russell stood. We're at 1785 right now. Yeah. So let's just say you remain bullish and you're saying, Liz, so what? Right. Where do you love to salt in some of the cash at the moment?
It's a barbell. So we own Amazon, we own Alphabet, we own some of the bellwethers that have been beaten down, and they still haven't recovered nearly a lot. We also like the ones with a massive margin of safety, and I know Luke's going to give me a hard time over this one. Not all REITs are created equal. So we like distress and dislocation, but it's got to be the highest quality. We actually, during the mini crisis last month, we put on 2 trades to play the mini crisis. We didn't buy regional banks. We bought Bank of America, and we bought Vornado. Commercial real estate is the most hated sector in the business right now. Why are we considering
Well, nobody's going back.
No one's going back.
They're 20% vacant.
To the B and C properties. We think this is like the mall crisis of 4 to 5 years ago, where we lost all the B and C properties, and Simon Property did very well. They have the Apple, they have the Lululemon.
Right, B and C is business to consumer.
B and C is the lower level properties. So with Vornado, you've got Madison Avenue, Park Avenue, Fifth Avenue, Sixth Avenue, like this, the best buildings in the best city in the world. And the stock, despite revenues being down 5% since pre-pandemic, cash flow down 10%, the stock is down 75%. It's trading at a 40% discount to book. The worst case scenario is priced in. It will get worse, but as the labor market loosens, more and more people are coming back to the office because they're nervous about getting laid off.
Okay, so if Tom's got his barbell approach, let me just say that I was scrutinizing this Bank of America fund manager survey, and they had the most heavily weighted long-short trades that fund managers are in right now. The first one was long tech, short the banks. But the contrarian one is long the banks and short bonds. Are you anywhere in that alchemy?
We also run a little bit of a barbell, but right now we have some of the same names that he's talking about. The other side, where we want to take risk and get some returns, we're doing through some structured products, taking 2 or 3 names. Last time I was here, we talked about NVIDIA. Now that's gotten a lot harder because since the last time, I think it's up $80. Makes it a little harder. But looking at some opportunities there. But again, I'm being really cautious because what I'm worried about are some of these REITs, and I know I'm going to get killed for it, and some of these other agency funds. You know, some of the REITs have put up gates. Everything's fine. Everything's fine except we're only going to give you a little bit of your money back. If everything is fine, why are gates up? Yep. Why can't you sell the properties that you have at the same prices or lower, right? And I think some of these funds have promised maybe around 5 or 6%. They target it, and then they say we're going to have some upside. But you know, one of your CDs paying 5%.
Well, that's also an issue too. Great to see you both in studio. Be still my heart, my traders. Tom and Luke, always a pleasure.